All right, hey, welcome. So today we're going to take a look at a quick insight on how to add to a longer portfolio options trade idea or strategy with options. A lot of people get into, buying the stock, and you can buy the stock. There's nothing wrong with that. It's just I want to show you how to do it with options. So this way you can kind of say, hey, I want to buy the dip. And if you're already saying, hey, I would have bought that stock at higher prices and now it's pulling back, then wouldn't you buy it now anyway? Yeah, you could, but there are probably some differences. Now, keep in mind, some of the things we'll go over here are not recommendations to buy, sell, or trade any stocks. It's just my own personal thoughts and opinions. So let's get into it and take a look at here, Apple. And as we get into it right here, you can check it out. And I've got a couple of positions on it already. So I've got Apple right here. It's down about $189. So I'm slowly starting to build up and accumulate this position. And as we take a look at it, I've got about 35 delta, which is basically 35 shares of the stock. So I'm looking for it to go to the upside, but it is negative. With the stock, as you can see, it's kind of going right here to the upside right here. There we go. It's going to the upside right here. And now we've got this little pullback, so I wonder if it's going to bounce here sometime soon. We will see. Time will tell. But I'd like to start buying in somewhere at this level here right now, kind of getting into it where if it does bounce, that'd be nice. But I don't want that huge risk exposure. So how do I go about doing it? Now, in order to do this concept, is known as kind of like a back ratio. In order to do this, you have to make it you have to be trading a little bit more contracts. So it might be something like you're basically selling vertical puts, but then you'll buy an extra one or two against it. So here what we'll do is we'll go to the 60 days. So let's say that stock has fallen further today, and now I'm interested in buying a few more of it. So I could say, okay, let me sell the puts at about 150. I want to go into probably about a 20-24 delta, so about 150, 155. Because if you get something like at 130 at about a 10 delta, 8 delta, there's not enough premium there to protect. So I'm going to go to 155. I'm going to go in, I'm going to sell, and we'll start out with a vertical for you. Sell a vertical. So there's a vertical. Okay, let's get rid of these positions, hide positions. Okay, so I've got this vertical now spread. Okay, now I'm going to need to go into maybe about 5, maybe more contracts. Because I didn't pre-test this. Go to custom, switch it to custom, and I'll go to 6, and I'll unlock the price. So now what you can see is if the stock tanks and goes down to 150, I lose about $131. If I didn't have that extra put, I'd lose $750. So think about it. Would I rather lose $750 or would I rather lose about $150? So anyways, this reduces your risk, but of course the most you can make now is of $231 because you're making less on the total profit if this continues to go up. Otherwise you could make $515. So the question is when would you do something like this? It's when I'm scared or when I'm worried or when I'm worried about a further pullback. I want to be cautious, but remember, if it does go up and continue to go up, like you're taking a shot at it, then this would still pan out and work out. So I'll do a 5-4 or a 5-6 spread. You could maybe do a 4-5. Let's see what that'll look like. You could do a 4-5 if you're more cautious, and then you get, like, you're slowing down your deltas and it's a much smoother curve. But yeah, you're only going to make about 130. Risk is about 1,800, but that's at expiration. So if this pulls back in the next 5 days, you're not going to lose as much, but you're taking a shot at it for a possible upside. Like maybe, hey, this could be a bounce. So yeah, you could do a 5-6 or a 4-5 ratio, and that's really what it is. It's basically known as a back ratio spread. Okay, and I'm receiving a credit on that. And what you could do is confirm and send. I'm going to pop it into my long portfolio right there, and now that it's filled, there we go. It is in there, and this is some of the stuff that we deal with the coaching and the mentoring students. So I've got some other spreads on here, but I'm allocating a little bit of cash here, a little bit of cash there. Just like a regular investor would, because if you believe in the stock, you're like, hey, I'm going to hold it for a little while. And that's why I went out to about February, because I don't know if it's going to be like this week, next week, or in a month from now. And if it does start pulling back on this spread, let's say to the 150, then I'm not going to take a huge bite out of the contracts. You're taking a shot. You're saying, hey, I'm buying the dip, but I'm buying the dip conservatively or cautiously or carefully. So anyways, that's really what I'm trying to do here. I've got this other spread as well that's also not panning out or working out really well yet. But again, from a long investor perspective, I got till March for this thing to actually be above that 170 price or so. Is it 165, 170? Yeah, 170. So anyways, this is how you might start approaching it. Now I'm starting to allocate more and more capital a little bit as the market heads lower. Again, you're buying kind of the dip. And what you can see here is if this stock really does go to like 0 or something, not that it would, not that I believe it, but let's say it goes to 80, you could see that back ratio actually helps you out quite a bit. Here's the 6-5 spread because it's here. If it goes to 100, you actually up quite a bit, $2,700, but I don't think that'll happen. But anyways, it gives you a little bit of a chance for, you know, downside protection as well. So anyways, that's what I want to show with you today. This is kind of the approach you might take when you're taking a stab on maybe buying the dip. With some protection on a big down day or a big market move down. There are other ways, of course. This isn't the only way. You could do things in many different ways to doing it and setting it up. I'm just showing you a different way to kind of hedge or offset that risk a little bit. Maybe something that you haven't seen as much before, but here's kind of another idea. And now we've got a layer of all these other positions. And if we look at all these expirations, you can see I've got a whole mix of positions, but really it comes down to my Greeks over here and what they're doing. So I've got, you know, Theta, Vega, Delta, I've got about 45 shares of it. It's nothing big right now, but you know, you're buying a little here, buying a little there, and with time, this position is starting to grow, and that's how you might approach it. So anyways, I hope that helps and gives you some things to think about as far as the stock. This market is acting a bit weak, so you can see it's selling off. So if I'm thinking that, hey, it might snap back up, and with Apple snapping back up, I might put on a couple of these here, you know, over next couple days. It might be today across different stocks and asset classes, and you're slowly starting to nibble a little bit, dip your toe in, because if you're a long investor, right, you're going to be holding positions for a longer period of time. So you would repeat that strategy. So if Apple goes down to, let's say, 160, you might be out of that one, but you might start one at 150, 140. If it keeps going down, you might do one at the 130. So hopefully by eventually 130, 110, it might work out in the same way that it went down over here. That, hey, you might have done these and you might have lost like 2 of them, but eventually, you know, that stock continued to move okay and well and panned out for a bullish upside move. So anyways, that's the primary objective and goal with these types of strategies. You repeat them on the same stocks that you would normally invest in for the long haul, or repeat month after month, week after week. If you want to do short duration, you could for the day trade, but you know, but you have more price sensitivity when you're doing that. So anyways, thanks for joining me. Hope you enjoyed that video. And if you have any questions, feel free to reach out. Let me know what you think of these videos and insights to trading some options and as far as allocating money and capital across a portfolio. Thanks, and I'll see you next time.